Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring someone in who's got something interesting to say about the economy, markets, property, and every now and again we have a chat with Olly Newland, who's an expert on property. And we want to talk today, Olly, about what's happening in the global markets and what it might mean for investors. Obviously, in the last month, we've seen real carnage on stock markets and concerns about slowing global growth. Does this mean that property's a better idea or not a better idea?
Well, I think it's obvious to everybody that the share market is really a den of thieves, and it's not for the small investor at all. And what I'm seeing is people are sick and tired of being pushed around by share prices dropping and rising and dropping, and are moving into hard assets, such as property being one of them, obviously. And more people are coming to me in my capacity as an advisor and are saying exactly that they're tired of having their share portfolios messed around with, and they'd like to get into something hard that they can see in the morning that's still there and has the same value more or less from one day to the next. And this is a trend that I think will continue.
But isn't property like any other asset class? It can drop in value as well as rise?
It does, but it's much slower and it's very localised. In the share market, if some gnome in Zurich presses a button and sells 1 million shares, all the shares in that company across the world are affected. It doesn't matter here. If somebody sells a house in Harry for half price, it doesn't mean that all the houses in the rest of New Zealand drop in value. And that's the big difference.
But we've seen in the United States, for example, that house prices have dropped 30–40%, which is actually more than the stock market's dropped over that time. Isn't there a risk if something really bad happened in the world that property prices could fall too?
Look, if things get that bad, you're right, nothing is protected. And this is why people are moving into alternative hard assets, because the main problem is that the governments of the world are printing more and more money. And if you can print more and more of any asset, then it devalues. And so people are, and look at the gold price. The gold price is a typical example of people putting their money into a hard asset. And also in the art market, the antiques market, which is a separate thing but altogether should be looked at, and the property market. So everything's possible, but as an addition to that, we have also the elephant in the room that we might have hyperinflation coming, which is hard to believe at the moment.
It's worth talking about this inflation idea, that all this money printing by the US Federal Reserve, the European Central Bank potentially, Bank of England, Bank of Japan, could fuel hyperinflation around the world. But when you look at what happened, for example, in Japan, where they've been printing money for a couple of decades, they've actually had deflation. And some people are quite concerned, and the markets are concerned, and certainly bond markets, that we're in for a period of very low inflation, maybe even deflation, because that's what we saw during the Great Depression.
All that is correct. We've got every option on the table at the moment. I'm just saying that hyperinflation is one of the options that could happen. You're quite right, the Japanese market has been flat, if not deflating, over the last 20 years. But you have to add to that the Japanese mentality is a little different from the rest of the world, because they have a different view of things, and that's the way they are. But I'm just raising the point that hyperinflation is one of the risks we're taking. At the moment, it's not a risk. It's not on the table, but it's there. But you see the beginnings of hyperinflation in the gold price, as I mentioned before, in the art market, and other property markets have had their day and will come back. And we have to keep an eye out that hyperinflation doesn't get out of control. But the main thing is that people are definitely shifting out of volatile share markets where they have no control into areas where they have some control, and that is property is one of them, and the hard assets I mentioned before is another.
What about, though, the idea you need some variety in your portfolio of investments, that you need some diversification?
Absolutely.
If you pulled out of the stock market and you were focused only on property and maybe precious metals, you wouldn't have much diversification.
I wouldn't say that you'd get out of the stock market altogether, but you shouldn't put more into the stock market than you can afford to lose, because you can't borrow against shares, or you can't borrow easily against shares, and also because the values change from day to day. And the property market and other markets like that, the changes are very, very slow and give you a chance to change. The other thing with the share market is that banks and lenders aren't very happy against lending against shares. It doesn't matter how much you try. When you go to a bank for a loan, they want security, and the security 99 times out of 100 is property. And so the system is geared towards that.
One of the risks, though, with property is that it's not quite so liquid as a stock market.
Right.
And although you say prices don't move much, often what happens is that people put houses up for sale and they simply don't sell for the price that you want. And we've got that at the moment with lots of houses on the market, but not many at what some would say are realistic prices. Isn't that one of the risks, though, that if you buy property, it's quite illiquid?
It is a liquid thing, but it depends what end of the market you're at. If you're in the popular price range, which in New Zealand is somewhere between or up to, say, $400,000, it is not that illiquid. It's easy to sell. Once you get past, say, $700,000, just as a number, and get into the millions, it becomes a bit more illiquid. There's no question about that. But at least it has a continuous value. And I think that's what people are looking for, is something that is stable. They're looking for stability in a volatile world.
If we do have continued volatility on these international markets, is there a risk that this would hurt global economic growth and New Zealand economic growth and employment, and therefore the ability of tenants to pay their rent?
All that is possible. Perhaps I wouldn't disagree with that. If the volatility continues and people abandon the share market, it's not good, because the share market has a use, of course it does, and people should be able to invest in the share market to help businesses grow, create jobs and so forth. But if you have constant volatility and people losing money hand over fist, and only people making money are the fund managers and the ticket clippers on the way through, then people will be abandoning it. And this is not good for business. I agree. A person's portfolio, where they can afford it, should include a mixture of shares and property and other hard assets and so forth, but not one thing or the other.
Olly Newland, thank you very much for coming
Pleasure.
in. Good to talk to you, and we'll talk to you again soon. I'm Hickey for interest.co.nz. That was another in our series of double shot interviews.